Demeter Advisors, let's take our conversation forward. Good morning.
Good.
With the markets at an all-time high, there should have been like a garmahat in your good morning.
No. I think I think markets are nothing to complain about. I mean, valuations are what they are, but I think flows and the expectations from growth perspective that lower interest rates and government expenditure should lift growth as the year rolls around. I think those are positives for the market. And I think your colleague was pointing out earlier, KEC received some orders, another railway company received orders. I think that's the nature of the beast we are dealing with, a capex, hopefully a capex-led recovery. That's what we are all hoping to see. So there's nothing to complain about. Hopefully the Middle East disturbance also simmers down. We'll see how that unfolds because it seems to we have to take each day as it comes. But in the domestic context, barring the valuations which are quite stretched, not much to complain about.
Remain stretched for an extended period of time. I mean, while we may talk about valuations, which all of us are talking about it, but it's a 2-year-old story that valuations महंगे हैं, yet markets it keeps on going higher.
See, because we are in a sort of a closed box environment. I mean, bulk of Indian savings can't leave India. What has been established beyond doubt to the retail investor over the last 20-25 years is that equities give you better return than bank deposits, both on a pre-tax basis and even more on a post-tax basis. So, shift of savings from bank deposits to equities is a continuing trend. Recent RBI data is also pointing to a shift in that direction. And this is very similar to what has happened in the US, for example, when the 401k shift happened sometime in the 80s and 90s. So that's what's driving up the market. I mean, if we were a capital open economy and if the investors had the freedom to invest anywhere in the world, I don't think the valuations would be as rich as they are. But this is how it is, and you have to take it as is.
For markets to go higher from here, we need a trigger and we need a surprise. What could be that positive surprise? Could it be earnings? Could it be anything else?
So I think, there's a lot of skepticism around growth. And I think while the RBI has done a reasonable amount of heavy lifting by cutting the CRR and reducing rates, and the government continues to push ahead with investments in railways and infrastructure and what have you, I think the private sector hasn't responded. And I think, that's the positive surprise that can happen since you're asking me for a positive surprise. I'm not sure whether it'll happen or not. I'm hoping. So I use the word hope, which doesn't have a lot of certainty behind it. But, that would be a real surprise. And then you could potentially get into a situation where your earnings trajectory improves from, 10 to 12% for Nifty, for example, for fiscal 26 that everybody's talking about, to maybe 15-17% for the next 3 years. Now, if that happens, then valuations can remain expensive for longer because then everybody starts focusing on growth, saying that, India is growing much faster than anywhere else in the world. There are no major macroeconomic imbalances just yet. So let the party carry on. I mean, that's the narrative that can evolve if you were to look for a positive surprise.
Ashwini, morning. This is Shrishti also joining in. So Ashwini, financialization of saving is driving the Indian markets higher. That's your take. But how should one take advantage of that in terms of the stock picking? Because of late we have seen all these AMCs, rather, some of these brokerage companies on the stock price movement, they have been doing well. But do you believe at this price point the valuations are fairly placed, or what's your take? How can one take benefit out of this?
Great question, Shrishti. Thank you. I think the capital market plays are already reasonably well priced. Now, of course, they will give you that 12-15% return, which is in line with the growth in aggregate market returns. Because, their business will grow by at least that much, if not more. But I think, what I would rather do is look for beneficial beneficiaries of a low interest rate regime. I think, the NBFCs stand out in particular because their lending costs are somewhat sticky, whereas the borrowing costs are likely to fall. I mean, just this morning I was reading a newspaper article which spoke about the rush into low-grade bonds or triple B bonds or double A or A minus type of bonds with investors looking for yields. Now, if that starts to happen, then you can see an improvement in the spreads for the NBFC. So that's one area that I would look at. In a similar vein, I would look at some of the smaller banks. Now, banks have a kind of a dual-edged sword in the sense that their asset book gets repriced faster than the liabilities book in the short run. But I think improvement in spreads will come from a lower CRR, and it will also come from a better loan growth. So I think, improvement in net interest income, not spreads, will come from these two factors, from loan growth as well as from lower CRR. So I think that to me is something that can hold some surprise. And valuations in this space, whether it's banks and NBFCs, are still quite reasonable. So this looks to be an area where things are looking good to me. And that's how one can play it, at least the liquidity part of it from an equities perspective.
Okay, Mr. Agarwal, point taken on the financial pack. Morning, this is Snehi also joining in the conversation. But other than banking and financials, they have been the flavor of the season of late. Other than this, if you adopt a bottom-up approach, what else is looking attractive?
Snehi, the healthcare sector continues to look quite attractive. This is, one long-term story that is evolving in India. Healthcare costs are rising, so whether it's health insurance or whether it's hospitals or healthcare service providers like diagnostics, etc., these will continue to grow at a reasonable clip. Now, in some cases, valuations are expensive, in other cases, they are not. So on a bottom-up basis, this is an area where one can hunt for some ideas. There are select opportunities in manufacturing as well. In various areas, whether it's related to exports or whether it's related to domestic economy. I think defense railways are quite pricey, but some of the core engineering companies are still looking all right. There are domestic services plays outside of financial services where one can look at. Now, I have to say that across the board, valuations are challenging. Okay, so it's not that there are any screaming buys out there, but I think relative to growth, you might find a few ideas here and there, but it's becoming more and more difficult to find very appealing bottom-up ideas.
Ashwini, so can I say that in this kind of a market where evaluation is the only risk, it is better to just stay on with the market, because if you are sitting on cash, you're losing on the upside. And if valuation comfort is a problem, then either time-wise correction would kick in or mild price-wise correction would kick in. Because it's not that valuations are at, those bubble levels. 100, 150, 200, those P multiples are not like that.
Nikunj, barring defense and a couple of other instances, you're right. Valuations are not super crazy. Okay, they are, let's say, slightly above median. For Nifty, for example, smaller companies could be slightly higher on an aggregate basis, but you can find bargains. Now, you raise a very interesting point. So, should investors be sitting on cash? I think, a lot of your viewers who are retail investors and are allocating savings to equities should never take cash calls. In the longer run, investing regularly into the market pays off much more than trying to take cash calls. So I agree with you that if valuation is the only discomfort, then one should just stay on. One should have the stomach for a 15-20% drawdown, the kind of which we saw in the month of March. But, as we have seen, buy the dips has been a very, very strong narrative for the last 2.5 years. And I don't see how that's changing in the short run, because especially if growth picks up. Now, let's say growth disappoints because, the US economy goes into a tailspin, doesn't look like it, but anything can happen. The disturbance in the Middle East becomes a lot worse than what we are hoping to see. Now, those kind of things can take a toll on growth. And if that happens, then there could be more downside. But till that happens, it doesn't make sense to take money off the table, stay invested. But for active investors, for allocators, and for people who love to time the market, I would be at the lower end of my tolerance range for an equities exposure. So if you're an investor who has, say, for example, 50 to 70% range as an equity exposure, you should be closer to 50% than to 70% is how I see it.
Ashwini, in this market, where do you think there is fear of earning contraction or P contraction, or perhaps both? Because everything is not growing. 12 to 15% earning is difficult to find, and there are a lot of spots like IT, or for that matter, a consumer, where even a single-digit growth is now a struggle.
So you said it. So those are the areas where valuations relative to growth make no sense. At least in the defense companies or in some of those engineering companies related to space or railways, they have very solid growth ahead. At least that's the hope. But in the consumer space, in the IT space, where growth is in single digits and valuations are whatever 30, 40, 50 times, I don't understand why those stocks trade where they do. But those are considered as free cash flow generators, very capital efficient as companies, and that narrative has expanded the valuations to levels which doesn't logically appeal to me. But that's my opinion, and that's an area that I'm not invested in, and I don't really feel favorably disposed towards that. But that's how it is.
In terms of themes, the last time you connected with us, you were positive on chemicals and pharmas, and what we understand is that these sectors are not just exposed to the overseas market. Other than that, there are vast sectors within, because there are select pockets in which one company does well, select markets that the one company caters to. But structurally, what is changing within these sectors, if you can give us some sense? Because for chemicals, some of the experts do highlight that the inventory issue that was there, that is subsiding, the market is opening up. But your thoughts?
Great question. See, in the pharma space, I think one big reset that will happen, or rather two big resets are possible over the next 5 to 7 years. It's a slightly longer term story I'm talking about, and it may not have any impact on stock prices or valuations in the near term. But structurally, a lot of brands that derive a premium, even though they are selling generic products in India, those brand premiums, I think, will contract. Because I think, there's no reason why a consumer should be paying 100 rupees, per tablet for a product that has versions of it available at 5 rupees or 10 rupees. And you'll be surprised to hear there are as good medicines available at 1/10 the price. And I think that awareness is starting to grow, led, of course, by the government's initiative on Jan Aushadhi schemes and distribution centers. But there are private sector companies that are dabbling there as well. So I think that's one reason. The second is, which is even longer term, is the focus on biologics and the focus on genetic medicine and genetic treatment levels. I mean, the kind of rapid changes we are seeing in diabetes management, for example, can make a huge difference to some of the older molecules that still dominate many of the pharma supply chains. So I think that's something to be aware about. In chemicals, I think, I continue to be positive on chemicals. I think the chemical companies went through a massive boom immediately post-COVID because of shortages, etc. And then there was an inventory glut, which has kind of ebbed, as you mentioned. And I think a normal trajectory is coming through. But they are global plays to a large degree, and there one has to be aware about what happens to crude oil price and what happens to end demand. And in many of these companies, what happens is that margins have a lead lag effect compared to how raw material prices move. So that's a volatility issue that one has to contend with when one investing in chemical companies. But having said that, I like them. I like chemical companies as well, and maybe I should have mentioned that along with healthcare.
Thank you very much. Thank you for your time, and thank you as always for joining us.
Thank you.
What do we have on the markets now? steady as it is, and the uptick is not powerful, but today